Well, good morning, everybody, and we'll make a start and welcome. And thank you for joining us for BOQ's first half results presentation for the 6 months to February 2016. For today's presentation, I'll be providing an overview of the result. Anthony Rose will then take you through the numbers in more detail, and I'll then return with priorities and the outlook for the period ahead. I'm pleased to report we've delivered cash earnings for the first half of $179 million, up 7% on the prior corresponding period. A major highlight of this result has been increased growth across our key business units and channels. The momentum in the broker channel and BOQ specialists demonstrates the effectiveness of our strategy to expand our business. We've also made good progress with growing our target niche commercial segments. Furthermore, we've achieved this growth without compromising on credit quality, which is fundamental to our strategy. The composition of our loan book has continually improved. It has benefited from geographical diversification that our new channels bring. Our net interest margin of 1.97% has remained unchanged over the half, despite fiercely competitive market and increased funding spreads and hedging costs. I'm also pleased to report that we've kept our underlying cost-to-income ratio flat. We continue to reinvest in strategic components of our business, including initiatives such as the retail lending origination project and a new lease management system, which will enable the retirement of 22 legacy systems. We have seen the benefit of our continued investment in our risk processes and systems, evidenced by a further 1 basis point reduction in our loan impairment expense this half. These achievements show the good progress we are making in implementing our strategy, positioning us well for the long term. Today, we made an important announcement regarding interest rate changes. We have made the decision to increase interest rates on our variable rate home loans between 12 and 25 basis points. This will help us achieve the appropriate balance between growth, asset quality and profitability. Despite these increases, our offering of products and pricing remains competitive, allowing us to continue to compete strongly in the segments we are targeting. Anthony will discuss the factors behind this decision shortly. Turning to slide 4. The highlight of our first half is the growth we've achieved in lending. You can see we're back above system for the first time in many years, with total lending growth of almost $2 billion or 10% annualised for the half. Around $1.7 billion of this growth came from our housing loans. Our commitment to niche commercial segments is paying off, with commercial lending and leasing contributing almost $300 million. Despite a challenging environment, we maintained our margin to grow net interest income by 4% on first half 15 to $467 million. Non-interest income of $85 million was up 1% on the prior corresponding period. However, this is down on the second half of 2015 due to a number of factors that Anthony will address in his section. The increase in cash earnings growth has enabled us to distribute a 38-cent dividend to our shareholders, while maintaining common equity tier 1 at a well-capitalised 8.8%. The charts on slide 5 show we're delivering quality growth. This has been achieved through the success of our multi-channel distribution strategy. We've maintained strong growth in BOQ specialist mortgages, with more than $1 billion written on BOQ's balance sheet in the first half. The mortgage broker channel was responsible for 19% of our settlements over the half, as we continue to expand our presence in that market. The potential remains to grow our broker originations by looking to utilise some of the larger broker aggregators in the market. With approximately 50% of all mortgages originating from brokers, there is still more upside for us in this channel. We continue to diversify the portfolio, with 62% of settlements outside of Queensland. The housing loans we've settled over the half represent a higher proportion of PAYG loans through the broker channel. These borrowers have historically demonstrated better risk characteristics than the self-employed segment, a segment which at times we have been overweight. BOQ Specialist has attracted a mix of professionals, most notably from the health sector, adding strength to the credit quality of the loans originated in the first half. On the topical subject of lending practices, we've taken a conservative approach. We are validating all applications through a centralised process. While it does slow down the process, this will continue to improve as we digitise. I am pleased with the continual improvement in our arrears and impairment expense, an outcome arising from our commitment to improving credit selection. Slide 6 shows that we continue to deliver on our strategic pillars. We have further expanded our mortgage broker presence with 3,200 brokers now accredited. Virgin Money provides another avenue to grow our mortgage distribution and diversify our customer base. The rollout of Virgin Money's new mortgage product is currently in pilot phase, with a launch scheduled in May this year. Across our business, customer numbers grew by more than 25,000 in the first half. Of this, close to 6,000 came through BOQ Specialist as its mortgage origination strategy continued its momentum. In the first half, we reduced our branch numbers by a further 10 as part of our ongoing branch network optimisation program. We've also continued with the rollout of additional Icon branches, bringing the total to the number 8. Across the Icon branches, we've seen an uplift in settlements, deposit growth and cross-sale metrics. Our new model for OMBs where commission paid is linked to a balanced scorecard and has been implemented in over 1/3 of our OMBs. For those OMBs on the new agreement, we've seen better outcomes across a range of performance metrics, including risk. Our retail lending origination program rollout is on track, with nearly 30% of new mortgages currently covered under the new system. This rollout will continue over the course of the calendar year, with approximately 70% coverage of our application volumes, which will improve turnaround times across all of our BOQ distribution channels. We have already witnessed a significant improvement in turnaround time from days to hours for eligible PAYG mortgages. In relation to our commercial portfolio, we remain vigilant on credit quality and in fact have tightened credit standards to reflect areas of risk that we've identified in the market. We have made good progress in our specialist niche strategy, building on our capability internally and growing our presence in target markets. Fundamental to our strategy is to continue to invest in our risk culture. Over the half, we've implemented and strengthened our program of monitoring and supervision across the entire bank. As a result, we've seen an improvement in our branch compliance. I am pleased with the progress we've made with our strategic initiatives. I am confident about meeting our goal to deliver industry EPS outperformance over the long run. I will now hand over to Anthony to talk through the numbers in more detail.
Thanks, John. On slide 8, we've provided the key line items of the P&L with comparisons to the prior periods. I'm not going to run through every line item on this slide, as I'll get into the detail of each shortly, but you can see that we've been able to deliver 7% cash earnings growth on the prior corresponding period and 5% in cash EPS growth. This has been driven through growth in net interest income, whilst operating costs and impairment expenses have remained flat. The comparison to the prior half contains some noise. We have a lower day count in the first half compared to the second half, which means reduced net interest income, although this had a lesser effect this year, given we're in a leap year. There is also the one-off operating model costs that were announced in February, of which $7 million has been incurred in this half, as well as a drop in non-interest income that I'll cover later. Getting into the detail on slide 9, as John's already covered, we've been successfully growing our lending portfolio, with total lending up 10% annualised for the half. Most of this growth has come through the housing portfolio, with the mortgage broker channel and BOQ specialists contributing the lion's share of this growth. We're also pleased with the geographic diversification of the portfolio, as it's continued, with Queensland now down to 48% compared to 60% back in 2012. I'll now go through each of the portfolios in more detail and explain the drivers of our growth. The chart on the bottom left side of slide 10 shows where we've come from in terms of housing growth relative to system. It's pleasing that we've been able to get back above system through expanding in our distribution channels. The chart on the right shows just how we've achieved this, with the diversification of our channel mix clearly evident in our housing settlements over the period. As you can see, the BOQ specialist mortgage strategy has again been a key contributor, growing by $1 billion, along with our mortgage broker expansion. Our branch network did deliver growth momentum in the second quarter, but was largely flat for the half. We reduced overall branch numbers by a further 10 in the half, in line with the guidance provided last year, and we expect a similar reduction in the second half. Whilst the network goes through this transition, we expect branch loan balances to remain relatively flat, given the growth we do achieve from our core branches is being offset by accelerated runoff in those branches that are closed or consolidated. As this transition in our branch network reaches completion and we extend the rollout of the new retail lending origination system over the course of the calendar year, we do expect to see improved branch productivity emerging in 2017 and into 2018. The differential price between where the industry is competing for new business and where the broader portfolio sits has persisted, if not widened, during this period. The industry response to the regulatory investor growth cap that increased front book discounts for owner-occupier lending has exacerbated the gap between front and back book pricing. Industry data suggests that recent activity in refinance between banks is running at the highest levels that have been seen for some time. We have been actively participating in this competition for new business to stimulate momentum through both new and existing channels, with a focus on balancing growth, credit quality and margin. The direction of change emerging in the regulatory framework, with the convergence of risk weights between advanced and standardised banks, is looking increasingly more likely, especially for mortgage risk weights, where the playing field is the most uneven. We believe the relative returns on the bank's mortgage portfolio, where most of our growth has been achieved in this half, is likely to increase directionally as this dynamic plays out, and will be positive to long-term value creation. In the second half of the year, we would expect a moderation in our overall housing growth as we adjust pricing to manage within the regulatory 10% investor cap and in line with the group's funding and internal capital generation capacity. Turning to slide 11 and our commercial loan and asset finance growth. The chart on the bottom left of the slide provides the comparison of our historic lending growth compared to system for commercial lending. It does provide a different picture to the housing story, with more subdued growth in recent halves. There are a few moving parts worth talking about. In the current period, we believe the increase in system growth appears to be elevated by activity in the larger end corporate market, warehouse facility financing and infrastructure segments that we do not participate in. In terms of BOQ's growth, we called out at our last results that we'd taken a step back from the market in the previous half, given some of the pricing and credit terms we were seeing offered in the markets where we were competing. We have not been willing to compromise on risk-return hurdles for growth. Instead, we have focused on the niche target segments we highlighted at our strategy update in November. We've seen an improvement in the pipeline for new opportunities, with growth in the BOQ business this half also being back-ended. We've continued to achieve solid growth in the healthcare sector through BOQ Specialist, BOQ Specialist benefits from being exposed to a high growth segment of the Australian economy, supported by a targeted niche strategy that resonates very strongly with its customer base. We're also making good progress in the retirement and aged care sector. We will continue to focus on these and the other niches that play to our strengths. The slide shows that in our niche target areas, we grew at a 19% annualised growth rate over the half. Outside of these areas, our portfolio contracted by 2% on an annualised basis, which is consistent with our approach to credit and return discipline in this portfolio. As an example, we've made a conscious decision not to write any new residential apartment development finance above $5 million for the time being, until the market has time to digest the existing pipeline of activity, and I'll cover this in a little bit more detail later. Moving on to slide 12, and our funding mix remains appropriate even with the stronger asset growth we've achieved over the half. Our deposit to loan ratio has remained stable at 66% as our customer deposits have grown at a 10% annualised rate for the half, matching our lending growth. Transaction account growth has also been strong during the period at 9%, albeit with a higher weighting to offset account volumes than we experienced in the 2015 year. The total level of long-term wholesale funding has remained stable year on year, with mortgage securitisation runoff replaced by senior unsecured issues. Wholesale funding markets have been volatile since the back end of 2015, with the results being substantially wider spreads required on new issues across the spectrum of funding instruments. The market volatility has also driven an increase in the cost of hedging the interest rate risk in our portfolio, which I'll cover in more detail shortly. Moving on to slide 13, where the charts show the key moving parts of our net interest margin, which remained flat over the prior half. We've provided a bit more detail on the moving parts as there are a number of additional elements at play in the present environment, and we acknowledge that it is a key area of focus. Looking at the asset pricing and mix impact, we've broken that out on the chart. The benefit of industry repricing in the second half of the 2015 calendar year contributed a positive 6 basis points to the margin profile. This was partially offset by the impact of front-to-back book repricing, the impact of elevated retention repricing due to the higher refinance activity across the industry that I'd called out earlier, and a further 1 basis point impact that was simply mix related, with a higher growth rates achieved in our mortgages over the half. These negative pricing and mix impacts, totalling 4 basis points, are actually consistent with the experience in the prior half. I'll now take you to the funding and hedging cost bucket on the chart. The benefit of funding cost and mix contributed 2 basis points to the result. However, I would call out that this is down considerably from the experience in the last 2 halves of 4 basis points contribution and 10 basis points contribution respectively. We'd previously flagged that we saw this trend emerging, given where retail deposit spreads had fallen to. Probably the biggest surprise that has emerged over this half has been the significant increase in the cost of hedging the interest rate risk in the balance sheet as market volatility has increased. We believe this will have an aggregate effect on net interest margin of 5 basis points, of which 2 basis points of the impact was experienced in this half, with the remainder impacting the second half of this year. A further 3 basis points of negative impact was caused by the lower returns from the replicating portfolio covering the investment of the bank's capital and low-cost deposits. This is consistent with recent periods and would be expected to continue with the low yield curve environment expected to prevail for some time. Looking quickly at the other factors, there was a positive effect of 2 basis points relating to lower liquid asset balances, as the maturity of our implementation of the APS 210 liquidity standard allowed us to reduce the conservatism that we'd been running with in the earlier stages of implementation. However, I would point out that this does not result in a positive contribution to net interest income. It is largely a denominator effect in the ratio. A higher proportion of third-party mortgages also reduced the margin by 1 basis point. Looking forward to the outlook, I've highlighted a number of factors in this walk that will continue to impact the margin position in the second half of the year. We believe the pricing changes that we've announced today will provide coverage against these impacts and support our expectation for a flat margin profile over the full year. However, we would caution that, as this half has demonstrated, there are a multitude of factors that will go into determining the actual outcome, and we would caution all to consider these factors carefully. If we now move on to slide 14 and non-interest income. Whilst fee income has increased by 1% over the prior corresponding period, the result is 11% down on the previous half. There is some fee collection seasonality weighted to the second half, particularly in the commercial portfolio, that equates to a couple of $1 million of impact. We did see a significant reduction in transaction fee income as a result of changes to interchange fees. This has caused a $3 million reduction over the previous half. More broadly, non-interest income continues to be impacted by customer preference for lower fee products. Our ClearPath mortgage product is a low fee product that, even after the repricing announced today, has a comparison rate that is very competitive. In the other income bucket, we did see growth of $2 million over the prior half, with improved equipment sales realisations in the BOQ Finance portfolio. The Virgin Money contribution is included in other income. The business continues to perform well, with average net receivables up 18% against the prior corresponding period, despite the portfolio also being impacted by the change in interchange fees. Trading income has reduced by $2 million following 2 strong consecutive halves. The St Andrews insurance contribution decreased in the period in line with our expectations due to a shift in the business mix and lower returns on its technical reserve investments, as we've flagged for some time. Pleasingly, first half claim costs reduced from the higher levels experienced in 2015. Looking to the second half, we would expect non-interest income to be at similar levels to the first half, adjusted for the impacts of seasonality that I covered earlier. Turning to expenses on slide 15, the cost-to-income ratio of 45.1% was flat to the prior corresponding period, excluding the cost of the organisational restructure program that we announced in February. In the half, we incurred $7 million of the $15 million estimated total cost of the program. John will talk about the scope and objectives of the program in more detail later in the presentation. On the slide, we've set out the carrying value of our capitalised software investments. You'll note the significant shift from assets under construction to in use during the period, as we've delivered key elements of our transformation program. This transition is occurring to expectation and driving the substantial increase in amortisation expense that we've called out in previous guidance. The expense profile in the first half places us on track to deliver the full year guidance of underlying cost growth from our existing businesses of 4 to 5% for the 2016 financial year. In addition to this, we expect to incur $3 million relating to the rollout of the Virgin Money mortgages in the second half. Moving to impairment expense, and we're very pleased with the continued improvement we've seen in the portfolio. The overall portfolio reduction from 18 basis points to 17 basis points has been assisted by the growth in the portfolio, with impairment expense of $36 million flat on the first half of 2015. Our housing impairments have reduced to 5 basis points, whilst BOQ Finance has moved back below our target 70 to 75% range, down to 67 basis points. Commercial impairment expense has ticked up slightly, with a small number of larger exposures having an impact, but overall we are not seeing any systemic issues emerge in the book. Slide 17 shows the balances of impaired assets, as well as the new impaireds as they've emerged. This reflects the comments I made on the previous slide, with the improvement across retail and BOQ Finance, but a slight uptick in commercial, reflecting the larger exposures that you can see in the chart on the right. Slide 18 shows our arrears performance across each portfolio. The usual post-holiday period uptick is evident, again in housing and BOQ Finance. The 90-day past due improvement in housing is pleasing. Our industry data, as John said earlier, demonstrates that our portfolio in Queensland is performing at industry-leading levels. Commercial arrears have slowly tracked higher, but consistent with the transition occurring in the economy, and we see no evidence of systemic issues at this point. Turning to slide 19, and we've set out some data on our exposures to the sectors that have been receiving plenty of attention from analysts and market commentators. As you can see from the graphic on the slide, BOQ's exposure to apartment developments is relatively small, being under $300 million. We do not have any exposure to Docklands in Melbourne and only one exposure in the Newstead precinct in Brisbane. As we've talked about in previous results, our regional and mining exposures are also minimal and are not creating any signs of significant stress on our portfolio. Turning to capital, and we have seen a reduction in our Common Equity Tier 1 ratio of 11 basis points to 8.8% over the half. I've previously covered the seasonality we have in our profit generation. There is also an impact with the higher level of asset growth we've had being back-ended in this period. This is obviously included in the risk-weighted asset growth without the full earnings benefit in the current period. There has also been the impact of reduced utilisation of capital-efficient securitisation with existing deals amortising and no new issues completed in the current half. With our expectation for lower asset growth in the second half, we would expect to see the reduction in Common Equity Tier 1 that we experienced in this half to reverse by the end of the year. We remain well capitalised relative to our peers, and we believe we remain well positioned for the regulatory changes that are coming down the pipeline. With that, I'll hand back to John to wrap up.
Well, thanks, Anthony. We continue to witness the transition from a resources growth-led economy to one that is more balanced. At a national level, the economy is holding its own, helped by a relatively lower exchange rates and interest rates. The transition is not without its challenges. The recent rise of the exchange rate would be one, although we believe that this is not sustainable. Uncertainty remains over the near-term outlook, most notably for the global economy. The economic performance at a state level remains mixed. New South Wales is doing well, but the mining-dependent areas of regional Queensland and WA are experiencing a difficult period of adjustment. The Queensland economy is showing signs of growth. There has been some pickup in business confidence. Over 50,000 jobs have been created over the year to February 2015. A lower currency helps tourism-related regions. Airport movements were up 17% on the Sunshine Coast and 9% in Cairns. However, they were down 15% in Mackay and Gladstone, highlighting the challenge in those areas. Brisbane is now being helped by the better performance of the service sectors. We continue to carefully monitor the economic conditions of each state and Australia carefully and remain cautious. The transition in the Australian economy presents opportunities for growth in our niche segments that we are targeting as part of our strategy. Turning to the regulatory environment. While there remains a degree of uncertainty around the next phase of new regulation, we are encouraged by some of the recent announcements. We continue to expect that smaller banks will benefit from a levelling of the playing field from changes to capital and risk weightings for advanced banks. We're also encouraged by the potential for a faster path to advanced accreditation. One of our key strategic goals is to broaden our risk culture across the group. We will continue to develop our risk systems with a view to preparing the bank for advanced accreditation. However, our decision to implement the program completely is likely to be determined by the Basel IV process and outcomes. Regardless, we continue to expect there will be further convergence between the advanced and standardised approach to regulatory capital. This should provide opportunities for BOQ to either drive additional growth, expand margin, or potentially a combination of the two. Turning to slide 23. We're operating in a challenging environment. As such, we will continue to improve our efficiency as we've done in the first half. We've kept costs under control. We'll continue to drive our cost-to-income ratio lower, and this will allow us to direct reinvestment to business, providing growth and in line with our strategy. In February, we announced a $15 million spend to deliver a series of productivity initiatives. The investment we have made is helping to remove duplication and manual process. We expect to get the full return within 12 months. Our plan is to redirect these savings to further invest in efficiency programs. We have fostered a culture of continuous improvement, placing us on the path to a cost-to-income ratio in the low 40s in the years ahead. There is also focus on establishing centres of excellence where it is sensible to do so, with mortgage processing being an initial priority. Currently, different processes are applied across our mortgage origination channels. Other efficiency programs include the digitisation of cheques, e-statements and reducing postage and courier costs. On slide 24, the strategy we presented to the market in November remains on track. We are targeting sector EPS outperformance over the long term through our focus on niche segments and the 4 strategic priorities listed on this slide. Earlier, I outlined our strategic progress. We remain focused on delivering the priorities we set for FY16. We've achieved growth by opening up our distribution channels. This has strengthened the quality of our book by attracting a more diverse customer base. We see further upside in our portfolio of businesses as our capability matures and we find more efficient ways to operate in established channels like our branch network. I'm excited about the opportunities that our new Virgin Money mortgage product will provide in reaching new customers. This will be rolled out by May, and Virgin brings with it the ability to attract a materially different customer demographic which complements the current customer profile. The next step for Virgin will be Virgin deposit products. I'm pleased with the progress we've made in growing our share in business segments we are targeting. We'll continue to grow the right way by making the right decisions around pricing and credit quality. These segments offer the bank higher returns and achieve deep customer relationships across the group. Our lending origination system is fundamental to the bank's ability to compete and will remain a key focus for delivery towards the end of 2016 calendar year. This will enable approximately 70% of mortgages to be processed through the system and brings us in line with industry-leading levels for the time to yes. As with any organisation focused on its customers, we continue to develop and provide our employees with the skills and resources they require to service our customers. We're introducing programs to embed a sales and service culture across the group. We're also making good progress in building a diverse workforce, with a focus on identifying and promoting talented employees in our organisation. We currently have 30% women in senior leadership roles and are on track to reach 33% by FY16. This places us on a trajectory to reach our aspiration of 50% by 2020. In summary, we've delivered today a set of results that highlight the sound progress that management has made in line with the bank's strategic objectives. The strength and quality of our lending growth is a key highlight in a challenging environment. We are pleased that these results demonstrate the success of our multi-channel distribution strategy. Achieving the optimum balance between growth, credit and profitability remains our number one focus. Our asset quality metrics have shown improvement and remain resilient. This is a testament to the systems and processes we've implemented in recent years. Overall, we remain well placed to capitalise on the opportunities that emerge as we execute our strategy. Thank you.
We'll take some questions.
Sorry.
Good morning, Richard Wiles, Morgan Stanley. I'm a little bit alarmed by the growth you're getting in the mortgage book. Since 2009, above system growth hasn't been a particularly rewarding outcome for shareholders at banks. In fact, the banks that have grown below system have tended to perform better, both on margin and revenue outcomes. In particular, it seems strange that you would accelerate the growth to 1.6 times system at a time when competition on the front book is getting more intense and when the deposit benefits are coming to an end. So I would like to ask, are you comfortable with that growth rate? Was it more than you expected in the half? Does it reflect your expectation that margins will actually expand on mortgages in the future? And how reliant is your view on the expectation you've stated today that I think that capital requirements will go up for the major banks and they will have to reprice?
Look, thanks, Richard, for your 8-part question. So I'll do my very best to answer the issues that you've raised there. Are we happy with the growth that we've got? We certainly are happy with that growth. It was a tale of 2 quarters in what we saw. In the first quarter, we did see some green shoots start to emerge as our distribution channels started to open up. In the second quarter, December was basically around plan. January, we did better than what we expected, and in February for us was quite a strong month. Traditionally, seasonality, the January and February periods are relatively weak for us. We also took the decision that with the macro-prudential at 10%, we were well below that, and we saw the opportunity to actually take up a little bit of our market share in that area. And when I think about where we are at the moment, yes, we have grown below system for a long, long period of time. I would not expect to see the same amount of growth in the second half, but what's really important for us is how we grow and what those risk metrics are. And I'll draw you back to some of the remarks I made. We validate 100% of all of our mortgages. There wouldn't be too many people that do that. We've actually, in some cases, tightened up some of the serviceability standards that we actually have. For a long while, this business, if you go back 4 years ago, was a single channel point of distribution, heavily focused on pretty much Queensland. And consumers deal with banks in many different ways. And part of our long-term growth strategy is to actually open up those distribution channels. Virgin Money, we're really excited about it, will actually bring us a completely different customer set. And also BOQ Specialists, when you look at those mortgages and the performance of those mortgages, even before we acquired BOQ Specialists, have always performed well, even though they weren't on the previous owner's balance sheet. So we're quite happy with the growth we're getting, but it will moderate in the second half.
Do you expect mortgage margins to expand? Is that why you're comfortable with that level of growth that's getting on the balance sheet at the moment?
I think as we've said today, there's an increasing likelihood of convergence still to play its way out, and our view would be, the return on equity on our mortgage portfolios is likely to expand. Now that can come in increased capital requirements for the advanced banks and potentially some repricing to offset that then favours our relative position, or some reduction in our overall capital position based upon where the new standardised framework recalibrates itself, or a combination of the two, and that would be our expectation. There is also an element in this that we've got to acknowledge that the new channels that we've opened up here, we have still been relatively new to those channels, and we have had to have a reason for, in particular, the broker channel, for them to do business with us, particularly with the high standards that we set around validation. And it's fair to say that we have been, in some segments of the market in particular, harder to deal with from a processing perspective through that period. But again, as we digitise, we'll make it easier for them, but we weren't prepared to compromise on those standards for the quality of the portfolio. So I think going forward, as we mature our presence in the various channels and the levers that we've got, the rate element that has been an element of this half is one that we would be much less pronounced on going forward.
John Mott from UBS. I'm just going to follow on from Walsey there. The repricing that came through today, quite substantial, 12 basis point standard variable rate and 25 basis point investment property loan. I've never seen a regional bank be a leader on price in the mortgage market, so I'm sure this decision wasn't taken lightly. So do we see this as, whoops, we grew too fast, oh no, our margin is getting hit, let's reprice that to stabilise the margin for the second half, because that's what it really looks like. And then when we go forward from that, you've just put a huge amount of volume on, you're turning the brokers on again. Isn't there going to be a lack of trust from your customers and to some extent a lot of frustration because you've just put this on and now you've gone and repriced out of cycle? And just to put it into perspective, your standard variable rate is now 30 basis points higher than ANZ and your investment property rate is 45 basis points higher than ANZ. So to me, and I know you've got your Clearview product and you'll probably respond that way, but you're a long way out of the market and there's going to be a lot of frustrated customers.
Look, thanks, John, for your question. And you're quite right. These decisions are not made lightly, and we thought long and hard about where our position is. And what we are dealing with is what is in front of us. We have seen a significant increase in wholesale funding markets, as Anthony outlined in his waterfall chart. We've also seen a significant increase in hedging costs. When I think about how we are positioned in the marketplace, we have always been competitive and will continue to remain so. The ClearPath product was introduced a number of years ago, and it was a low fee and a relatively low rate product. It has got one of the cheapest, lowest comparison rates of any product in the marketplace. So our go-to new customer rate is about 4.19%, and our standard ClearPath owner occupier is at 4.72%. And again, they are still very competitive rates in the market. There is probably less reliance across the industry on the standard variable mortgage rates. And as you would all know, in the acquisition of customers, there is substantial discounting that goes on under the counter in that marketplace. And our ClearPath product is quite transparent in that. And look, sure, we always take into consideration of where our customers are. What I will say is that we've grown our customer numbers by 25,000 over the last 6 months. If you look at Virgin, for example, it has 200,000 customers at the moment. And the ability for us not only to actually attract new customers to the bank is significant, but also new deposit customers as well. So decision not taken lightly. We're comfortable with where we sit at the moment.
So this is really just reprice the back book and compete aggressively on the front book and hope the book doesn't churn too quickly.
No, that's not the case at all. I think, Anthony, all of you would understand that in the industry as a whole, particularly in subdued credit environments, and then when you actually overlay the macro-prudential, that all the banks are competing out there, and it has been a facet over many years of where that front book, back book pricing dynamic is. ClearPath for us is a product that actually looks to break that dynamic because it's quite transparent. Its pricing, it doesn't have a lot of fees attached to it, but again, we're part of the industry. We are competing in the industry, and we've got to do what we can see is what's in front of us.
I'll just add a little bit to that. In relation to the step that we took on investor pricing, it's fair to say that we went from an annualised growth rate of our investor book in the 3% range to finish at 7.8%. And as John said, we had a very large February with still some solid momentum. So part of the step that we've taken there reflects making sure that we do manage within our 10% cap in the coming months. We'll obviously continue to monitor how we're going in that part of the market going forward, and we'll continue to monitor our position in that space going. But it's fair to say that 10% cap does create some issues when you're managing your portfolio and making sure you maintain and operate underneath it.
It's Andrew Triggs from Deutsche Bank. Just a question on how you manage the growth in the various channels. Clearly, part of the strategy has been that the low or the quite aggressive pricing has been to get growth back in that OMB network as you reduce the branch network. Is there a better way to manage that through targeted discounts in that channel relative to the broker channel? That's the first question. And the second question is, do you have specific targets and expectations for the Virgin Money mortgage product?
Look, from my long experience at previous institutions where you actually have differential pricing between, say, branches versus brokers, that doesn't work very well. And when you think about our owner manager network, it is based on a commission model as well, and as is the broker channel. So the returns that we actually get on those mortgages are very similar through those channels. What I will say too is that a lot of customers who actually go to brokers would choose not to go into a branch. So it's we are channel agnostic, and I think that if you went down the path of very, very differential pricing, that's not going to work very well, and I've experienced that firsthand. We're quite comfortable with where we sit in terms of our channel distribution. Virgin Mortgages will be a materially different product. We'll be launching that in May, but again, it will be appropriately priced. I'm not actually going to put out the expectations around the growth numbers for Virgin Mortgage. I don't need to alert all of our competitors around what we're going to be doing there, but we're very comfortable with the product that we'll be releasing, which will be different to what we actually have in BOQ and BOQ Specialist. And when I think about the Virgin brand, we've had it for a period of time. It's done exceptionally well, particularly in the credit card market, particularly in its insurance markets. It's got over 200,000 customers. It grew 11,000 customers, in the last 6 months, and it gives us a wonderful opportunity to continue to grow in a materially different way to what we would have done 3 or 4 years ago when we were just a monoline distribution channel.
Just on that pricing dynamic, do you think you're a little bit slow to react to a lot of those 3.99% mortgage rates that are out there? Really were pulled probably a couple of months before you have. Is that and obviously the February growth was a bit of a lagged reaction to that.
Yeah.
Perhaps you need to. In the past, you've said that the pricing committee that you run is more able to be quicker responding to factors like that.
Again, if I just go back to those earlier comments I made to John, for the first 3 months of the year, we just saw some green shoots, and obviously January and February were months that we saw materially different growth to what we'd experienced over the last few years, and there was a confluence of events. Obviously, with the macro-prudential, I can't speak for where other institutions are, but everybody's looking and managing to the 10%. We took deliberate decisions to keep where our prices were for the long term, given where our views that Anthony's put out there around where we can see convergence coming or not in accreditation. But we were surprised in February. There was no doubt about the size, and then we took some steps around that. And of course, we're ever vigilant, and as I've said in the past, we'll continue to fight for every basis point that's out there in terms of on both sides of the balance sheet.
James Ellis here from Credit Suisse. Just a question around the non-interest income. At the AGM, you gave full year guidance for non-interest income, and in the first half there was a sequential pullback which was attributed to both structural and cyclical factors. Now, acknowledging you have made some statements about the second half, how do you feel about the AGM guidance now? Because it would appear that it's probably a little bit more under pressure, that guidance from the AGM than today than what it was then. So just whether you could comment on
look, we gave that guidance as what we could see in front of us, and obviously Anthony outlined in his charts the number of moving parts there. There was also, during that period, there was resolution around the interchange fees. There was a fall in our trading income. And look, we are a small bank with a good strategy, a sound strategy, and we're not a bank that actually sits there and takes punts on markets and does those sorts of things. So we're obviously disappointed with what the operating environment is in terms of their non-interest income line. Again, when you think about the industry as a whole, the industry is looking for much more transparency. And, if you go back to where our products sit, such as ClearPath, it is a product that doesn't have a lot of fees. And it's been our go-to product for a considerable period of time. And consumers want that transparency, so that's also impacted as well. But I'm quite comfortable with the guidance that I provided at the AGM is what we were seeing in front of us at the time.
I think the other point to highlight there is that the the numbers in the market from the analyst community in the non-interest income line had factored in a material level of non-interest income growth. That at the point in time we gave that guidance that it's flat was well below where the range of expectations were. Clearly we've had things like the interchange fees, which weren't on our radar at that point in time, that have further pulled back on the actual outcome.
It's Ed Henning from CLSA. Just back on housing for a second. In AFG in March commented they experienced difficulty in processing loans and that volumes fell. Does this concern you that you've pushed the volume through the broker channel before the systems are ready? And obviously you still see as a growth going forward despite pulling back your prices.
That's a good question, Ed, and I just want to come back to a couple of points earlier that I made, and it's very, very important to understand, is that the whole industry is under considerable pressure around its responsible lending, and that's rightly so. And we've been very conservative. We literally check 100% of our mortgages to ensure compliance with what we do. And yes, that did slow things down. But it's incumbent upon all of us, particularly in this heightened scrutiny and also with where the housing market is, to ensure that borrowers are able to repay their loans, not only just at the current interest rates, but if interest rates moved higher. So, we took a deliberate step to validate all of our mortgages, including what we do through BOQ Specialist, the broker channel and the owner-manager network. Our lending program is on track. Our time to yes has materially improved for PAYG mortgages. About 30% of simple mortgages are going through now. So we've gone from, Anthony used to talk about it, we couldn't even work out when a mortgage hit the desk of our branches to, for simple mortgages, being able to give the answer in a day. But I don't make any apologies for the validation that we're going through at the moment.
So you don't see it as an issue for brokers might be a bit shy to go back to BOQ because they can't process their loans?
Look, we've worked very closely with the broker aggregator groups that we actually have, and we're very upfront with where we've been. And of course, we're always looking for a path of continuous improvement, and we're still investing in our systems and process to streamline that. But again, we haven't opened up ourselves to the very, very large aggregator groups at all because we just wouldn't cope. And we're being smart about how we go about that until we get all of our processes and systems up into place.
Just a second one on the new impaired assets. You talk about they're all uncorrelated industries. Can you just run through what industries they came through?
Sure. So one was a real estate agency business in Western Australia. Another was an electrical contractor in metropolitan Perth, and the other is a quarry in northern Queensland.
Thanks. Brett Lemestre from APP. Question on how your OMBs are travelling. I gather from the settlements information that you've provided that the loans outstanding provided by the OMBs haven't increased very much for a while. And so I was wondering, particularly in light of the increase in rates that you've announced today, how they're travelling, and also what pushback they've given you today on your announcement.
Yeah, thanks very much, Brett. We actually saw some good growth through the OMB network on the last couple of months, and we've worked really hard over the last 24 months to get a balanced scorecard, and that balanced scorecard really reflects not just home loans but also deposits and also risk outcomes. And we've seen a significant improvement across the board in deposit gathering and also a significant improvement in risk outcomes. And in fact, we've seen a material lift in branch audits to satisfactory over the last few months. We work very closely with our owner-manager network, and in fact, I've spent the last couple of months travelling around visiting a lot of the OMBs. It's not just mortgages; they're also looking at commercial loans as well. And we're pleased with what they're doing, and they are custodians of our deposit base. They are hard-working people in their communities. And under Matt's leadership in the retail bank, we've done a lot of work to be able to improve their business prospects as well, and we're comfortable with where we sit at the moment. The issue around raising our rates, again, it's not something that we do just lightly, and we considered all stakeholders in this. And again, we are dealing with what we're seeing in front of us in the industry, particularly around hedging costs and increased wholesale funding costs.
And if you, just to further that comment, John, if you look at the elements that I called out in the margin walk, the vast majority of those impacts were not related to the pricing position that we had in the market over this period. They would have been there, emerged, and existed irrespective of whatever position we took. So again, we see that as as important consideration. And just more broadly, Brett, the other thing to consider obviously is the work that we've been doing around the transformation of the branch network. We are down in the order of 40 owner managers over this journey in branch numbers, and that obviously in absolute terms creates its own degree of noise. The quality of the owner managers that we have amongst our group at the moment is obviously lifted as a consequence of a lot of the steps and actions that we've taken, and they're successful in delivering. We're comfortable with how that's tracking.
We might just see if there are any questions online or on the telephone.
The first question comes from Craig Williams from Citigroup. Please ask your question.
Good morning, everyone. Look, given the industry doesn't appear to be having much luck deriving net benefit from its efforts to reprice lending as far as observed in recently reported net interest margins, is your announced repricing move today a function of your bias perhaps towards pursuing profitability over volume from here on in? And what percentage of your expense base is variable with volumes and activity levels, please?
Yeah, I'll just talk to the around the repricing question that you've done, Craig. Again, when we look at this, it's we're always looking at how we're executing against our strategy, particularly against the segments that we want to be involved in and the actual business units that we actually have. And again, repricing decisions are not taken lightly. But again, it's all about the long-term profitability of the bank and our aspiration to continue to grow back to our EPS target that we talked about at our recent strategy day and what we spoke about today. There's no doubt these are choppy markets at the moment, and we are responding to what we see in front of us, particularly in those external markets. I'll draw you back to where mortgage rates as a whole are across the industry. They are at very low levels, historically low levels, and also the ability for consumers with those lower rates to actually service those mortgages. But again, we're also being very judicious around where our risk settings are for the inevitable change in rates. Who knows when that will be, but we want to make sure that our customers can pay their loans and we're lending responsibly. And it's about us executing on our strategy over the longer run, and that's how we think about our pricing decisions.
And the answer, Craig, in relation to the variable expense base, clearly the largest element of our expense base is our staff costs and employee costs. So, really the volumes and the support and fulfilment services that are required to support our activity really relates to the staff complement that we've got. So that would be the largest variable mover in the dynamic of our expense base.
Is there any other questions online or on the telephone?
Our next question comes from Victor German from Macquarie Bank. Please ask your question.
Thank you. I had a couple of questions. The first one, first just a point of clarification maybe from Anthony. If I look at slide 13, going through that net interest margins, you've highlighted that capital and low cost deposits had a 3 basis point negative impact, and as you've highlighted, given where the rates are, it's a permanent impact. I just wanted to understand, are you saying that there is ongoing impact on margin in the second half from this issue, or is it just the permanent kind of 3 basis point reduction that should moderate in the second half?
Oh, that was 3 basis points in the prior half as well, when we would expect 3 basis points in the second half. Over time, it will amortise down, but what it reflects is we have a 2.5-year weighted average duration investment profile on our capital and low-cost deposits, which effectively means that 1/60th rolls over every month over a 5-year basis, so you're effectively investing at the 5-year part of the yield curve. So if you think about where the yield curve was 5 years ago, out at the 5-year level, that is rolling off at 1/60th and coming on at the new 5-year rate today. Yeah. So that is the profile of that dynamic. It will slowly, assuming a constant yield curve, the rate of degradation will slow, but we don't expect that to be much different in the second half.
Right. So just kind of aggregating what you've said, you're expecting 3 basis point or around 3 basis point reduction, and that you're expecting around 3 basis points reduction in margins from hedging, funding and hedging costs, and obviously you're getting that repricing benefit come through. So if I take your comment that year on year you're expecting broadly flat margin outcome, given that first half 15 had a higher margin than in second half 15, should that be an indication that you are expecting slight uplift in margins in the second half?
No, we haven't.
Is that kind of
the two items you've called out aggregate to 6 basis points. There's a flow-on benefit from the repricing that was undertaken in November, because there's a full year impact of that, yes, which is about 3 basis points of impact, and then the pricing steps that we've announced today equate to about 6 basis points. Again, that's a spot view, and then the other factors around the repricing elements, we see as a further continuation, absent any changed either competitive dynamic or wholesale market or hedging cost dynamic that would play out. Our view highlights an expectation of persistence of current dynamics.
Right. Sorry, just so I understand. So are you saying that you're expecting kind of flattish margins half on half, or flattish margins in 16 versus 15?
No, half on half.
Half and half, right? Okay. And then just the last point of clarification. Earlier question from James on net interest income. So do we take your comments as, given all the information that we know today, it's probably going to be difficult for you to meet your earlier guidance? Is that the right way of thinking about it?
I'm struggling to remember us providing.
So the guidance was for flat to slightly increasing non-interest income line.
Sorry, non-interest income. Yes, correct. Yeah. Consider this revised guidance.
Right.
Yeah.
Okay. And so the last question is a little bit more forward-looking in a sense from, and we sort of touched a little bit on that on volume growth, and. I accept that this question might be a little bit redundant if the industry reprices in the next couple of months. But given that a lot of your growth is coming from ClearPath product, which doesn't really have embedded discounts, are you comfortable that you can still maintain sort of around system to slightly above system volume growth if industry doesn't reprice?
Look, the way I'm looking at that is not over the short term, but over the longer term. If you think about what we discussed today, you've got our broker channel, you've got our owner managers doing better than what they've done in the past, you've got Virgin Mortgages coming up. We're not going to put a specific system target out there, but it needs to be, for a long period of time we were criticised for not actually growing at system, but the way we're looking at our growth is to make sure that our distribution channels are growing the right way and growing profitably. This is a materially different bank from where it was 4 years ago, where it was only an owner-manager network. We've got BOQ specialists that has performed excellent since we've made that acquisition. and we always saw the strategic benefit in that acquisition of putting the mortgages onto our balance sheet. We've got a world-class brand in Virgin, and we'll look to bring Virgin to market. But with each of those businesses, they've also got targets around their deposits as well. So it's not just we're not just talking about mortgages. And I'll point you back towards what I said earlier. The expectation would be that the second half growth in terms of mortgages will be moderated.
But it sounds like if for example, you're suddenly not growing at system, that wouldn't concern you in the short term.
Correct. Yep.
Okay. All right. Thank you.
Is there any more questions online?
Yes, the next question comes from Ms. Ashley Dalziel. Please ask your question, Ashley.
Morning, guys. Just a question on advanced accreditation. You've reiterated again today that you're pretty happy to wait on what the next wave of regulation might look like before making any decision on advanced. Just hoping you might be able to help us reconcile that position against, firstly, APRA's recent comments that we're unlikely to have any clarity on what domestic application of that next phase might look like until 2017, 2018. And then secondly, the fact that two of your regional bank peers are now formally going through that accreditation process. Just thinking, is it the case that we might not hear anything definitive on this for another 1 to 2 years?
I think the way we look at that, and I am going to defer to the Chief Risk Officer as well, is that we've been on a significant journey to improve our risk systems and process. There's no way that we are going back to where this bank has been in the past, where you've seen significant loan impairments. Everything we do is around ensuring that we have the most robust systems so that we can get through the inevitable cycles that the Australian economy has. Having been through 2 advanced accreditations, they are very, very expensive. But also it's incumbent upon us to actually see where the Basel Committee lands. Our understanding is that there will be we'll pretty much know towards the end of the year where Basel will stand, and then we'll have to wait for our own regulator to see how they want to apply that in a local jurisdiction. But again, everything we're doing in our risk culture, our risk systems and process is with one eye to accreditation. Peter, do you just want to add to that?
Yeah, I probably can't actually add much more to that. I think by the end of this calendar year, notwithstanding some of the comments APRA's made, I think it'll be quite clear to standardise banks on what the future looks like. And whilst I think the gap or the benefit there has historically will substantially narrow, I think we'll be in a position to, I think, make a formal decision, perhaps early 2017. And as we've said previously, we have done a lot of the foundational work, so we wouldn't be starting from scratch.
Okay, I think there's one more question online.
Thank you. And the final question comes from Mr. Scott Manning. Please ask your question.
Thank you. Morning, guys. 2 questions, please. Firstly, on slide 10, you're referring to the housing settlements by channel, and there's quite a strong proportion there from BOQ Specialist. I'm just hoping you can confirm what that's actually referring to. Is that the off-balance sheet component coming on balance sheet, or is it genuinely new-to-bank customers that means that it's ongoing growth over a sustained period?
Yeah, Scott, you're correct. What we've seen, again, I'll go back to that previous comment, when we acquired BOQ Specialist, their mortgages were going through to third parties, and again, we could see we could see there was considerable upside when we made that acquisition to be able to put those mortgages onto our balance sheet. Just to give you an idea, BOQ Specialist has grown 6,000 customers over the last 6 months, and we've actually been through a leadership change, and it's now led by Dr. Brett Robinson. That business is performing as we expect. The arrears are as we expect, and also we don't talk about it a lot, but on its commercial business, it's growing at 14%. This is a business that banks medical students all the way through to practitioners, clinicians, specialists through their life cycle. It's got very, very, very deep customer relationships. It's a very customer-centric model with deep understanding of the industry. In fact, they do over 800 functions a year to be with their customers, and it's been a wonderful acquisition for the bank, particularly when you think in light of our strategy around pursuing those niche commercial markets and the added incentive for us has been to bring those mortgages onto the balance sheet.
Thank you. And secondly, on the capital on slide 20, basically implying that your underlying capital generation is broadly neutral, and it was the impact of absence of securitisation, capitalised software and the like that drew the core Tier 1 ratio down. Do you think you'll have sufficient profitability to actually look to grow the dividend in the second half after keeping it flat half on half this period?
I think the guidance that we've given previously around, if you look at our cash EPS growth to prior corresponding period, is the type of growth rate that you would expect to see in the dividend. And that's really what should constrain over the long term your profile of dividend appreciation. That guidance remains, and obviously we'll need to see how the second half plays out, and that'll be determination for the board as to the extent of where that dividend lands.
Are there any more questions online? If not, we'll leave it there, and we'd invite you all to have some morning tea with us as well. So thank you very much for your attendance. Much appreciated.